Thank you for the opportunity to talk about one of my favorite subjects, which is market profile. And it's really one of my favorite lenses to organize the market and structure my perception and read what the market is trying to tell me. So today's workshop, what I thought I'd do is really work with you on a very practical approach. Because if any form of technical analysis is useful to us, it has to boil down to telling us, what are we going to do here? Where are we going to buy? Are we going to buy or sell? Is the market in congestion? Or we are in the middle of a trend or about to initiate a trend? What's our targets? How do we know we're wrong? So today, I'm going to take you through those steps. And I hope, usually this talk is fairly dynamic. I like to interact with the crowd, but for purposes of time, I'll answer most of my questions. But if you feel like nodding, or if you have a sense of where the market's going to go when we start with more of the charts and forecasting the profiles and what they're trying to tell us, feel free to shake your head and have call-outs. So, I'm a firm believer on what we think determines what we see. So what does that mean? With any form of technical analysis, what it's trying to do is structure our perception so that we can see these random patterns from non-random market activity. And so to give you a sense of what I mean by that, I have been taking training with a brain trainer. It's not uncommon in the States. And the first thing he did was an intake. And he sat me down and he said, okay, I want you to do this exercise. It was my intake. And I'll tell you, this is probably going to be one of your best takeaways because you can take this home to your family. But what he had me do was he had me circle my fingers. And he had me go around, and I'd like you to try this exercise. And he had me circle my fingers just like this. We can all do this very simply. And then he said, okay, reverse your fingers. I got that. And then he had me go around forward again. He said, now, as you're doing this, what I'd like you to do, stay with me. Keep your right hand circling forward. And now, just simply reverse your left, going in the opposite direction. It's crazy. All of a sudden, your mind, and I struggled with this for a very long time and finally said, this is because you don't have the neural pathways built yet. And so, he said, in about 30 seconds, if you can believe this, you're going to have built those neural pathways, and you're going to be able to do this. So he told me, all right, what I want you to do, and if you'll follow along, I want you to visualize a cube right in front of your eyes, a cube. And now I want you to place your fingers right on top of that cube. And take your right hand and your right finger and move it toward you, and your left on top of that cube's top, and move it away from you. And now just down the sides of the cube. Keep visualizing the cube. And now underneath the cube, and let your fingers pass the underside of the cube, and now up the sides. And now you can keep that going, and you can go faster and faster with that motion. And now all I've done is structure your perception so that you can do this exercise. And we've just built a little neural pathway. And that's what technical analysis can do. It builds neural pathways. If our perception is being structured in the right way, we can really see the market. And that's what I find about market profile that's so fantastic. It's my favorite lens to organize the market and read into the market and see what it's telling me. Because just imagine, in the old days, when we had to use the ticker, the price bars already facilitate how easy it is to organize and see the market. But with market profile, we take this to the next level because price, while it tells us some things about the market, there is a lot of information being generated that the price bars are leaving out. And that's half the market information. And that is really, how are those prices being used? So when we look at this chart here, when you see this monthly price bar, what you don't see is, one, is any price within this entire range considered more fair than another? Is this market ripe and ready to move directionally? Is it going to stay trapped in this range for another month? We don't see that in a price bar. But when we organize that according to how those prices are being used by the market participants, all of a sudden that monthly price bar just comes alive with information, right? All of a sudden I see, wow, this area right here is the most used price. And these areas are perceived as less used, or they are less used, and they're perceived potentially as less valuable right now. We also might know that this market might be ripe and ready to move or not. And we're going to go through this organization of the market today and have a better idea by the end of how to structure a strategy. This is the primary thesis of market profile. And I don't even really call market profile. I call these charts price usage charts because I find usage of price far more relatable, because it is a direct reflection of how a trader perceives price and is accepting or not accepting that price as fair. Because if you're willing to use it, you're converting it into fair price, to value. So this gives you an idea of what I mean by this. This is price of gas at the pump in Chicago. And if you look at this chart back in 2006, we remember when price first hit around $4.26 a gallon. And that was met with shock, rejection of price, and people actually started changing their behaviors. They started biking to work, they started working from home. They stopped using gas. Now what's happened is you can see over a period of time since 2010, there's been a conversion of that price into fair. It's starting to become accepted. And you'll start to see that this price is being used over and over again. Now, when the price hits $3.68 or $3.39, we're excited to buy that. We think that's a deal, where before it was thought as unfair. So market profile is less a form of technical analysis in my view, and it's more a visual display. It's the cube. It structures our perception. And it's a way to really track this progression of price becoming accepted as value through usage. Peter Stoudemire used to say, really, this is the DNA of the market, and it's fitting that we should be talking about this today, because he recognized this fact long ago, that if we track how people are using price, we're going to track really where that market's going and what it's telling us. So I won't spend a whole heck of a lot of time on the basics of market profile. I'd like to get into some advanced concepts with you today, and then you can go at your leisure and read about how it's actually constructed. It's on a number of platforms. In the profiles that I build, I usually do a little bit longer term. I find them quite valuable for stock analysis and long-term, macro pictures. So my bar charts, as you can see here, I use a base chart of a daily. And then what typically most platforms do, many in the old traditional way, is they convert those price bars to letters. That's not necessary, but that is what you'll see quite a bit of. And then each vertical bar, to create the profile, each vertical column is moved over as far to the left as it can. And if, like in D, if it starts a new range on a day is making a new high or a new low, it's moved to the very furthest left column. And that continues on. And as you can see, when it's moved over and shifted all to the left, lo and behold, it creates and self-organizes into a bell curve. And the market, which is fascinating about the market, is, and what Peter Stoudemire discovered, is the market naturally organizes itself into a bell curve. So that allows us to start to apply a host of statistical principles that we can to a bell curve. And so I'll show you the ones today that we're going to work with and what I really rely on. Number one, the mode. And that's the most traded price, and that's fair value. Also, for the value area and top a value area top and bottom. I use the first and second standard deviation for my work. And I actually keep an eye on my tops and my bottoms. If an auction has been shut off at the top and at the bottom, what you'll usually see is a single print, meaning it's done a good job, an efficient job of shutting off the buying, shutting off the selling. When you start to see these auction highs and lows being used, it's usually a precursor to those highs being taken out in the future because the auction was inefficient, it didn't do a good job at the first place. So that actually is, that's really what Apple was looking like, and why there are some times when you can buy a breakout and sometimes when you shouldn't. And what you really look for for a transition of when the market is going to really start to pull away from these highs is you'll start to see a period where the market will use these highs over and over again. And those usually lead to fairly explosive moves, especially when you have no frames of reference above you. So the power of market profile is really organizing this data to reflect these complete cycles of market activity, which I call the bell curve, and that's the organization into fair value. Now, we don't want to be locked in to artificial time, day, week, month, etc. We really have to get used to organizing according to the natural process of the market's organization, which is market time, and that's the creation and completion of the bell curve. So a lot of times in this month, this is an annual price bar of the 30-year bonds, but really how we should have been organizing that year is according to one, its completion of the bell curve, and two, its distribution out of the fairest price. And if you start organizing into these cycles, you're going to be able, that's the foundation of how we're going to work with this form of visual display. Now, what you'll notice is this is a period, there are two forms of, as the process of the bell curve develops, you'll see an underdeveloped bell curve, which I say, that's no consensus. The market is still negotiating and rotating. This is what I call a developed bell curve. Consensus is reached, and both of these represent two very different trading opportunities. Determining value, underdeveloped bell curve, accepted value, ripe, ready to move. If you play for a breakout range, if you play for a breakout in an underdeveloped bell curve, your strategy is likely to fail. If you play for a directional move when a consensus is reached, your strategy is likely to succeed. But in a market that looks like this, where consensus is still being built and the market participants are still determining value, playing the bottom of value, selling the top of value is really the preferred strategy, and that's when range trade will succeed. So let's just sum this up. Market, basically the beginning of the auction represents the determination of value. And the completion of the auction, that's when the market's ripe and ready to move. And so market consensus looks like the bell curve. So if you're good with that, let's start doing a little bit work on the difference between how we organize and how we organize these profiles. The difference between market time and clock time, again, is about the bell curve. One of the biggest questions I get from people I work with is, well, I don't really understand how we organize this data. What do I do when I get to my chart? And the way I like to do it is when you look at this chart, you can see this is all, these bell curves, while some of them are complete in and of themselves, they're really all part of the same larger bell curve. And this all should be put together, all that's in B. And this up here in A really is still part of the same structure, still building the bell curve. And so when reorganized, it looks like this. And if you organize it according to the completion of the bell curve in B and A, now we have something to work with. But what do we do now? Where's this market going, and how do we proceed? What I like to do is I rely on this fundamental concept. And this is really from my work, this is what I've come to understand, that markets move from high usage to low usage. And this is how they develop, and this is how they create new value. And so if you take this bell curve here, this is at B and at A, what we really need to do is we conjoin the bell curves. Here's our high usage at A and B. And once conjoined, we find that we have this low usage pocket. And this is how I proceed. I take a completed bell curve, I take what happened in the past, I join it in, conjoin them, and I look for the low usage areas. And that determines to me what's the next directional move, what's my targets, how long is it going to take to fill in this pocket, and where do I buy and where do I sell. And you can see at C, the market initiated its next move out of B and rallied and is on its way toward A. So this is the basic premise. Here we have 7 months of trading where the market just spent time in development. And this is during these 7 months, the market is, you could buy the bottom of the auction, sell the top of the auction. Bottom and top of value are where you should be playing this market. Now, as you start to bring it together, what do we have now at A? We have a completed bell curve. And what we have to do now is we need context. So we're always bringing our current foreground or our current bell curve that's complete. We bring it into history to see, well, where's this thing going? So I take A. This was history. This was the current bell curve that you were just looking at. Let's go back. Here is where we landed. And when I pull it back into history, I see that the pocket of low usage is below me. So according to theory, if markets move from high usage, which is this area, this is my high usage area, and will be bracketed between the two high usage areas, this pocket of low usage should now be filled in. And so there are certain areas to trade when you have a phenomenon like this in the market. One, you can certainly, it's late, but it's not too late, to sell the ledge of high usage. And that tells you that the market's rapidly going to move to its next ledge. This pocket provides very little support for the fall. So markets tend to move rapidly and have high volatility through these pockets. And they make a beeline, because markets are smart. They make a beeline to the next ledge, and then they start the development. When we have any negotiation, if you and I are going to bargain for something, you're going to start with the highest price, and I'll start with the lowest. I don't start with somewhere in the middle, nor do you, and then work our way out. And that's why markets are so efficient, and they're so smart. And so as we typically will get the high first, the low immediately after, and then the markets will develop within this range. And you can see that that pocket of low usage held the development for months until the process is ready to start again, and that bell curve is complete. So just to sum up so far what we've gotten, we're talking about the bell curve. We want to organize the market into these full cycles of market activity. In order to anticipate the next direction, we have to take that completed bell curve, and we have to always be putting it into context of the last area of development. And we look for where these low usage areas are, or pockets, to determine what's the next direction, where is this thing going. Here's an example of the yen. Now, when you look at yen up here, it's a fully developed bell curve at A, but we have no idea. Is this market going down, up? And as soon as I put it into context of past development, I have a clue. My pockets are above or below? That's my first question. Below. Now, one of the things that I look at, this is a common pattern that you're going to see a lot. Multiple pockets, multiple ledges above or below you. The question we're going to talk about in a little bit later is, how do you know if it's going to maybe spend some time here first and then move lower? But overall, the idea would be, strategically long term, you want to be placing yourself up here for a long haul to the downside. But ultimately, what I do to determine whether I'm going to spend a little time here first before heading down here is I look at the relationship of the two ledges. So that determines a lot in how much history I'll bring back. It's possible that at A and B, given the time frame it's going to take to fill in that pocket, that I could have kept with just this area of development for a while. But once the development starts to exceed this, or this and these two ledges start to equal each other even more, then I need to bring in more history. And that is the determining factor. And so the market did, pretty much at D, make spent some time of development and then initiated down. And if I break D out, you can kind of see filled in that pocket of low usage, and then it became its own bell curve on whatever time frame you might be looking at, and then made an initiation down to that ledge. In fact, what had happened there, it took enough time through the development to D to build a large enough ledge to overcome the lower ledge, and that's what's triggering the decline. Now, if any form of analysis is true, it should work on any time frame. It should work on any kind of market. And so I brought you a spread. This is a crude spread. And you see A, B, put them together, pocket of low usage. You're at the bottom of the ledge. What would you do here? Just take a minute. Right, buy the bottom of the ledge, look for a move up to 640, and play for the development of the pocket. So you have a strategy here. Buy the bottom here. How do you know you're wrong? We'll get into that a little bit, where breaking this ledge tells you you're wrong if you're going long. And if you're selling here, getting over this ledge of high usage at the top. And if we move forward, we can see that pretty much held true for the spread, and the market stayed trapped in development all the way through C. So this context tells you one of two things. It tells you, should I be trading a long-term trapped situation where the market is sell high, buy low, or should I be ripe and ready for a new directional move? And should I be positioning myself during this development in anticipation of that move, which is what I do. And that's what I'd like to teach in the next slides here. You don't really want to wait until the bell curve is finished and to say, well, I think I'll sell the breakdown of the ledge or buy the breakout of the ledge. That isn't your best advantage. It's all right to do if you're coming in to the market at that point. But really, you want to start bringing in context towards the last 60, 70% of the trading range to see, where is this market ultimately going to resolve, up or down, and start to lean on one end of the range trade during the development. So the concepts we've learned right now is range trade under developed bell curves, conjoin past bell curves, look for a pocket of low usage, and trade for the development of that. Now, just to keep me honest, I have worked with this gold chart since I started a CME report in 2011, and then have given a number of presentations, and usually using this gold chart throughout the time. The audience has always been able to get it right. I imagine you will too, just using this theory. But I've taken it up to date, and I haven't stopped. But if you look at gold in September 2011, let's just look at the elements of a strategy. Do we know direction? Are we going to be in trend or consolidation from this chart? Ask yourself. Are we ready and ripe to move, or are we going to stay trapped in this pocket? And the answer is we're going to stay trapped in that pocket, right? So we're in a range trade strategy. We do not want to buy a breakout. We do not want to sell a breakdown. We also have an entry location. The market closed right here. So we have a target, we have a stop, and we kind of have a duration for the strategy because it's going to take a heck of a long time to fill in this pocket into a bell curve. And then we have to have an alternate scenario. You have to know if you're wrong. So anything can happen, but if you're selling this point right in here, you're thinking that this market is probably going to head down here, and these are your two sell and buy areas. And you'd be playing one, at least what I say is a minimum target when you're buying the bottom of value and selling the top is a return to the mean. So somewhere in here is the minimum target. Now, at this point, though, remember that gold was in a major uptrend. And so what I'd like to do, going with the momentum, at the very beginning of development, I like to play, if the market's been in an uptrend, I like to play the bottom of value, or if it's been in a major downtrend, that first test to the top of value is a major play. So that 1550, those of you who trade gold, you might have had your own reasons for being all over it, but being all over 1550 was a great first shot at the bottom of value for the first pullback, because it looked like this. If it was ripe and ready to go in a fully developed bell curve, would have been a completely different story. So this is what the market did. Now, towards this period of time right in here, that's when you have to start putting the market into context. So somewhere around 60% through, you start bringing in your history. Now at A, it's a little late. Probably not going to get that opportunity to sell high or buy low, depending on your strategy. But A is the conjoined of all of these bell curves and range, because they're all still trapped within this development, and that's what it looked like. So if you asked yourself, is this market ripe and ready to go? Are you looking for direction, or are you looking for further range trade? You'd probably be answering, I'm looking for a new direction. And so as I brought new information back, here was the completed bell curve I just left you on. And I start bringing back history, and there's B. And I asked the group at that time, well, based on markets move from high usage to low usage, where is this market going? This is its close. The minimum that you would say is somewhere in 1420. The problem with that is the fact that if you look at this ledge, it's way overcome this ledge. We really haven't found a matching ledge. And that's what determines for me how much more data I have to keep bringing back, because this is unlikely to stop the decline. So what I showed them as well, I said, well, yeah, you could get to 1425, but what about 1250? Now, if you looked at that, and actually that's all I had at the time, they all said, well, it's probably going to go to 1250 because markets move from high usage to low usage. Their strategy was to sell the mode at that time. Ideally, if you had started to bring this into context earlier, the trading strategy is starting to sell the top of value. You want to be seeing where those pockets are as the market, your edge in this trade is up here at 1775. And so the market pretty much made a beeline there. And as you start to bring that in, you can see here the market spent very little time cutting through that pocket and went to 1250. And now, for today's presentation, I just brought in as much information as I could until I found some matching ledge. And that creates the target of 980 in gold as a minimum next drop. So that's what I saw, a lot of raised eyebrows when they were all forcing themselves to say 1425 and 1250. But market got there so quickly. And the reason it got there so quickly is there was a pocket of low usage. There was nothing to hold it up. And now here we are in a very short-term profile. And what I wanted to show you is how you have kind of matching combinations. C is not quite fully developed. B is not quite fully developed, but your main target is 980. So what's your strategy here? Are you going to buy low in this underdeveloped short-term profile or sell high? Well, you have a great opportunity, I think, to be selling against 1375 into the top of that pocket, because ultimately your long and short-term strategies are dictating that you want to be on board for this ultimate decline. And so you had many opportunities to keep selling against that 1375 ledge. At this point, if you take C and combine it all together with this little last bit of development, now you're a little late to be selling high, but you have a completed bell curve, don't you? You can almost visualize it. See how this D period right in here just finished up this last little bit of development, cleaned up the pocket, and the whole profile is ripe and ready to move, both the background and the foreground. These are some of the best patterns that I've found. When you get this foreground bell curve that has been fully developed, and when conjoined with its background, it's ready to go. And that's what it looks like now, and here is the whole thing all combined into one. So here you have a background that is a very full pocket. This is the last match we have, and that's dictating the 980 decline. Kind of matches what John's saying about a macro decline in gold onto the horizon. 30 years. So if you look at this, are we in congestion or trend? Congestion, right? Where are you going to buy and sell in this scenario? You're going to sell the top of value, you're going to buy the bottom of value. So your strategy here is buying 145.20 to 44, that's the bottom, maybe for return to the mean. Selling the top of value, maybe for the bottom of value. So we have a trade entry, we have an idea of the quality of trading we're going to see, and we have a long way to go for this thing to develop. So it's going to remain a consolidation market for quite some time. Now, alternative scenario, if this market started to take out that area right in here, or take that area out, I would be skeptical. That's one of the things I would just stand aside and say, I'm not going to play that. Because breakouts in these ranges, they usually fail. So I would stand aside with that strategy. And you can see, selling the top of value, buying the bottom of value, that maintained a really great strategy for, I don't know, 8 months of development. But now, are you going to keep that strategy? That's what A looks like at this point. Are you going to buy low and sell high? No. Now, what do we have to do? We need context. So let's take A, put it in context, and we have this. We now have 2 completed bell curves, pretty much of equal mode size, so I don't need to pull back much more data for now. And I look at this and I say, well, now if I'm not in the market and I haven't positioned myself on one end of the side of this trade or the other, I would be willing to both buy and sell because these ledges are fairly equal. Selling break of 48, buying the bottom of 43, and trade for the other side, maybe putting my stop above the ledges here and here. And you can see that C spent a great deal of time organizing that way. The key is, at this point, you need context. And if I give you the big picture here, this is what bonds look like. The foreground had pretty much fully developed and had fit in right into this pocket. And when I look, and this ledge had started to overdevelop all of this below it. In fact, this ledge right here had exceeded this, so making the target more like 122 at the time. So what are you going to do? Now, with context, I have a trading strategy. Most people say I'm going to sell below that ledge, but during the development, again, you wanted to be selling high. And either having a target of 29, but likely 22. And so the market made a bit of a beeline here. And now what I've done is I've taken C and D, and I've combined them. So over here is our foreground. This is our background. So is this foreground, D and C of the bonds right now, fully developed? No. That's a range trade strategy in the bonds right now. This is, this market is still going to be fairly trapped between here and here. Now, I may have a longer term strategy, so I might have an edge to sell high. I still think that market's going down a lot lower, but I would be willing to, here you might want to sell and hold, and here you might have to have a tighter stop, a kind of a shorter term time frame horizon if you're buying. And this is pretty much what's been going on. You've been given the opportunity to sell this zone. I think it's a great opportunity to continue to sell high in the bonds. For ultimately, what we're looking for is a much bigger dip in this market. But right now, when I combine all the bell curves together, what you'll really see is you're going to be trapped in development for quite some time, still, in the bonds. So overall, you pretty much, you can see the market has already started dropping from that. Selling high against this ledge is your long-term strategy. And I would really try to get in more towards the edge of 29 because buying's not really my bias in the bonds, but selling, you'll have opportunities probably to sell this year. So after I had an idea to talk about sugar, I brought an example, but after talking to a lot of you, I realized that equities might be of interest. And so I put in a few equity charts of what I actually had in front of me that I had to create a portfolio around. And I've chosen this time because I book this portfolio on this date every 15 months. And I was stuck with these stocks, and I have a certain portfolio of stocks that I have to select from for this client, and there might be 100, and I have to sift through them. So in a top-down analysis, if you're applying profile to stocks, this is what I do. First thing I do is I actually look at the sectors, and I look for this same pattern. And when I did it this time, I noticed that tech stocks really had the highest opportunity. If you look at where the stocks were right at this time, they were just peeking over this ledge of high usage. And I didn't feel it was too late to buy tech stocks because, as you see, look at the pockets of low usage above you. In fact, this ledge doesn't nearly meet the ledge below you. So from this chart, you could assume we could have over 35% gain, potentially a 60% gain in tech stocks. Now, tech stocks, I overweighted, and I still am holding them. I think this is the place to be. And financials at the time were also great, but they were going to meet, unlike the tech stocks, they were going to meet a lot of usage up in here. So this would probably be their cap. But for a 12 to 15-month portfolio, that was a good enough play. And this is what has happened in both of those. You can see how financials have started to slow down. And they're slowing down because look where they are. And they are more likely to start their range trade strategy, where tech stocks haven't hit it. They have still a lot more upside potential. Going from your sector idea, so you're thinking, all right, I like the tech stocks and I liked the financials, then I drill down into the stock basis. And I'm looking for those same patterns. Where they showed up were in a handful of the stocks that I had to choose from. Many of them were in the regional bank holdings. And as you can see, these stocks just were picture perfect. High usage, a lot of low usage over me, coming out of these ledges of usage. I basically took all the information I had to create these profiles. So this is the full amount of history for the stocks. And there is nothing that is really overcoming the ledge that they've come out of. A little bit here, so I would say PVTB had the opportunity to get to about 65% from that moment in time. And that's where they are now. So PVTB is probably time to exit that idea. I mean, that's good enough, and that suggests there's probably rotation, maybe a little bit more in HBAN, and you can see. So this form of analysis can be applied. I did the same thing for the financial stocks. I'm sorry, these are the tech stocks. This was TQNT, and I couldn't believe at the time that it really could get to 175%, or it could go up further than that. All of these stocks were suggesting huge potential gains, and that's where it is now. If I didn't have a buy and hold portfolio, I doubt I could have even held it that long, but as luck would have it, I wasn't able to, you're not able to get out of these kind of unit trusts, but that is really how that stock has performed. And there's still a bit more upside in here and TQNT if IRF is pretty much over in terms of its expectations. So that is the end of my formal presentation. Open for questions. I just wanted to recap a few things. One, what we learned today is that this is a lens, a visual display for you to be able to read the market. And this is how the market self-organizes in terms of showing you the perception of the trader's acceptance of price as fair or unfair. And what we do is we look for these bell curves, we conjoin them with history, we compare modes to help us determine how much history we need, and then we set a strategy around these ledges of high usage. I wanted to just pay a little tribute to Peter Steidelmeier, who developed and is the founder of Market Profile, and he has made an enormous contribution to our industry with Market Profile. So thank you for your time today.
Questions, Robin? Always got one.
In your experience, which markets have you found to be, for the market profile to be most used? I mean, you've shown us actually quite a nice diverse set of global risk markets, but I'm just curious if there were some markets that were more effective for this form of analysis.
Well, there's two ways to answer that. There's one, the markets, and two, there's the time frames. So in terms of markets, I use it for every market because it is the market. This is how it self-organizes. So I had a sugar example I didn't have time to give. I use it on every commodity and future. I use it on currencies, everything, ETFs. In terms of time frames, because I believe that we're really looking at market consensus, I don't believe that a 30-minute bar chart has enough consensus to give us enough holding power or information. So, but I do find these long-term charts, I can trade short-term. So if you have a form of analysis that you want to put in context, these are great macro. They're not macro charts. They're just a large slice. They're the whole market. And at these points of top of value or bottom of value, you can find yourself thinking you're a long-term trader and you've just sold a ledge and it's going to take you one day to get to a target that we used to have to wait months to get. So, good question.
Hi. With all the examples you've been showing, you've been using completed distributions as reference points. What do you do if a market's breaking to new highs or to new lows?
Like the S&P, for instance, right?
Yeah.
Right, or Apple. So there are a lot of refinements. Usually, there are two refinements I covered today that I usually don't talk about. One is the quality of the modes and relationships to how you know how much data to bring back. Another one that is where do you start the initiation of the profile from, where do you start? The one that you're asking about that I alluded to is the usage of highs and lows. So with the S&P and with Apple, because it's in your mind, so think about that Apple chart. When you are really moving into uncharted territory, like you were in Apple, there's a tell that the market will do. And it will start using the auction high, not of a day, not of a week, but of these long-term profiles that I've shown you. And what you'll start seeing is a lot of usage of that price too high, of that top. And then what you'll see is the conversion of that auction top into fair value. And you'll see it turn into a bell curve. And that's the moment that you know that this thing is going to be explosive. That's what the S&P looked like. That's what Apple looked like. So if you had raised your hand when you saw that chart of Apple, of this is ready to go higher, and that was a true analysis that you could have said that, because what you saw in that chart was Apple had started using that high and using it just like that gas chart, and it had created acceptance. Because what the market's trying to do at an auction high, which is harder anywhere else in the bell curve, is to bring in buyers high. That's a hard thing to do. Bringing in new participants at a top of an auction takes a lot longer, and what it looks like is a completed bell curve.
The ledges areas can be quite wide. You showed quite a few of them. Do you overlay any timing technique in order to refine when to exactly sell by the ledges?
I think I have the question right. So I let the market tell me when it's ripe and ready to move by its progress of full development.
Oh, sorry, maybe I should refine the question. The ledges areas can be quite wide. So do you have an extra technique on timing in order to make sure that...
Yeah, I do, actually. If you haven't taken your position at the top of value or the bottom of value, and you're not well positioned during the auction development, and you find yourself at the mode, and you're too late, you think, the market will have tells inside that mode to give you a sense of its next direction. And it has a lot to do with how it is separating within that mode away from its minor usage areas. So I will often take a very long-term mode, right? And I will break it up and I will look at the shorter-term mode relationships to price. And if I call it the push or the scoop, but if the modes are continuing to push within the context of the large developed bell curve, I have a good sense that where I'm going to go. That's a tell. Or if I see the shorter term mode starts to scoop over the market, it's a good tell. The market's ripe to distribute lower.
Is there any other technical indicator you find that could be that could enhance the performance if combined together with the market profile indicator? Thank you.
So I think the key, there's only one question I ask of the market every day. And when I sit in front of it, I said, what's the market trying to do and how well is it doing? So that means you have to know who's in control. You got the buyers in control, and then and how well are they doing? And what a buyer is trying to do is always separate from value and always separate from high usage, right? That's success. So I built a number of my own indicators just around that premise for myself. But one of the things that you want to do you really want to look at anything that you can sniff out the order flows. Because in a mode, if you think it's going to go higher, you want the sell order flows to be drying up, and you want to see buy order flows coming in. And so I have developed indicators that track that because that's true to the market. So anything that you can find that tracks order flows, I think will help you at the tops, bottoms of values, and at the mode. But I don't use price-based technical indicators.